You are listening to KeyStone Stock Talk Podcast, episode 53. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week in our Your Stock Our Take segment, we take a look at BioSyent, Inc., symbol RX on the TSX Venture, a specialty pharmaceutical company engaged in developing pharmaceutical and healthcare products. Its primary line, the Ferramax line, is an iron supplement. The company has been a microcap success story, rising from below the $1 mark to above $10. Our listener asks if we still like the stock. Our star of the week is TeraGo, Inc. TGO is its symbol on the TSX. It operates 5 data centers serving 3,000 business customers across this country. However, it is its first mover advantage into the 5G spectrum that has driven almost all the 30% move in the past 2 weeks we've seen in the stock, making it our star. Finally, our dog of the week is Encana Corporation, symbol ECA on the TSX. A leading North American diversified energy producer. The company recently reached an agreement to sell its San Juan assets located in New Mexico for $480 million US. Since the announcement, the stock has dropped over 16%. Is it an overreaction, or is this dog now an opportunity? Now let's dig into the show. I'm going to welcome back my co-host, Keystone Senior VP and Senior Analyst, Aaron Dunn. How are you doing?
I'm doing good, Ryan. I'm doing good. Just busy over here. A lot of research. We're putting out the cannabis report over the next couple of weeks. So 109 companies. Obviously, everybody's been hearing about the legalization nonstop over the last 2 days. So it'll be interesting to get that out.
It will be for sure. I think it's going to be a great basis to start looking at this segment. There's not a lot of fundamental value that we see right now. The fundamental value we're finding is just in really unique individual situations, and we should have a couple of recommendations over the next couple of months, new recommendations, and we continue to update all of our companies that are in our buy portfolios at present right now to clients after completing our 7-city tour, which was very exciting.
It was exciting
for all of us. Yes. Now, we get into our Your Stock, Our Take segment. This question comes in from a listener. It is just signed as from the Aussie, so I'm going to assume this individual is Australian, so we're going to answer the question. The question is, BioSyent is a company you have profiled in your cash risk reports. The stock did very well, then has plateaued in its current range. What do you think of it now? Well, let's get into that. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. BioSyent Inc., symbol RX on the TSX Venture, trades around $950, $930 in that range, $140 million market cap. What does the company do? Again, they're a specialty pharma company engaged in the development of pharmaceutical and healthcare products. Its products include Ferramax 150, Cathogel jelly, Ferramax powder, Repigen, Prokitis M, Agulent Systems, and Sysview. The company, through its subsidiaries, sources and acquires or in-licenses pharmaceutical products and markets these products throughout Canada specifically. Now, the key points here to look at on this stock, it's what has it done in terms of revenues in its last quarter. There's a 5% increase up to $5.91 million. Net income came in about around 4 to 5% up at $1.62 million. And adjusted EBITDA was up 2%. So not a ton of growth in that quarter, but there has been consistent growth in this business over the long term. And over the last just 3 years, you've seen compound annual revenue growth rate of just around 19%. So that's pretty solid growth there for this business. The balance sheet here is great. There's no debt, and it has cash and cash equivalents of around $21 million or $1.45 per share. So on a valuation basis, is it looking good in this range? Now, the stock trades at around 21 times earnings when we remove that cash. This is not exactly cheap and is slightly more expensive than the market. The growth historically has been above the market level, but we saw, again, that slowdown in growth in the last quarter. Is there anything to explain this? Well, we look at the company's MD&A and find out that the slowdown in the quarter was largely explained by a drop in international sales, which for this company can be volatile. In fact, international sales for the quarter decreased 31%. That was because of a shipment that was originally scheduled for that quarter. It was held back, and it was shipped again subsequent to the end of the quarter in Q3. So there should be better international sales in Q3. They can be lumpy. The Canadian pharmaceutical business, which is the core business, rose 16%. So the growth there was decent. Now, if it, right now it's growing its earnings around 15%. If it could creep those earnings growth up level to the 20-25% range, we would give the stock serious consideration. As is right now, we think it's trading at around fair value, so we'd have a hold on it right now. We'd also like to see further diversification from away from its our highly successful Ferromax iron supplement line. Again, keep that product chugging along, keep the growth there. But it is a huge percentage of the overall revenues. If they can have some product diversification, which is happening now, it's just still not a large part of revenues. If we can have that, then it wouldn't be a one-product essential company, essentially. So we'd like to see that diversification, and that would help it move into the buy range that we'd like to see for it.
I suppose one thing you'd like to see, Ryan, would be for them to employ that cash into maybe an acquisition,
it's a good point.
buy another product and diversify that way.
Yeah, and I think they're doing. At some point, they may do that. At some point, they may employ that cash. I think they're prudently building up that cash right now. I don't think they believe that there has been anything out there that is in a very attractive range. They've made some product acquisitions, but not a major product acquisition. So at some point, you could see them employing that cash, and then the earnings could uptick based on that, and that would be a driver going forward. I'd rather have the cash on the balance sheet than have this company heavily laden in debt. But at some point, they have to employ that, and it's a good point you make.
Be nice to see.
Yes, for sure. So do we want to look at our dog of the week next?
Sure. Why don't we do the dog next?
From our Stars and Dogs segment, it's time for this week's dog.
So our dog of the week is Encana Corporation. The symbol is ECA on the Toronto Stock Exchange. Trades for $14.47, has a $13.7 billion market cap. So the stock has come down about 16% over the last couple of weeks here, trading right now about $14.50, as I said. So Encana is a leading North American energy producer. They have energy production assets throughout North America, and that includes both natural gas liquids, and crude oil as well. So what is causing the company's woes right now? Well, on October 1st, Encana announced that its wholly owned subsidiary had reached an agreement to sell its San Juan assets located in New Mexico for $480 million. Since that announcement, the stock has dropped about 16%. No other updates have been announced. So just taking a look at Encana's recent financial performance, it's actually been pretty strong. They put out their second quarter report in August. Cash flow from operating activities was $475 million, up almost 120% from the same quarter in the previous year. Their second quarter production was about 337,000 barrels of oil equivalent per day, up 7% year over year. And they're firmly on track, they say, to grow their production this year 30% over 2017 numbers. So that would put them in the 400,000 barrels of oil equivalent per day to 425,000 per day. And what they've done is they pursued a market diversification strategy, and this has really helped their pricing. So for Canadian oil, you essentially producers receive a very deep discount, but Encana has diversified outside of the Canadian market into the Permian basin in the U.S., and that's really helped them achieve higher prices per barrel on average. So the debt's a little higher than we would like to see. Trades at about 7.5 times current year's cash flow, which is not bad, not particularly ridiculously cheap either. But a company, it's interesting because I remember Encana from years back, and it was once a pure play natural gas company, and they really got hit hard for several years. There was just nothing but negative news coming out on them when natural gas prices declined after the financial crisis. And what they decided to do is diversify into becoming also an oil producer as well. So this has worked well for them. The stock price has traded in a range over the last couple of years. I would say that it looks like it has some promise. One of the things that we do look for are companies that are growing their production as opposed to just benefiting from increases in commodity prices. But for us at KeyStone, being fundamental analysts, we don't like the commodity sensitivity of these types of businesses. So if, for example, oil prices start to take a slide going into the future, there's really very little Encana can do to protect themselves from that. Even if they are increasing production, that may not be enough. So for KeyStone, this isn't a company that we would pursue. The financials don't look that bad, but the market's not liking something over the last couple of weeks. So we have it as our dog.
That's a great summary. I'm going to move quickly on now into our star of the week. From our Stars and Dogs segment, it's time for this week's Star. Is TeraGo Inc., symbol TGO on the TSX. What does TeraGo do? Well, they have over 3,000 business customers on a cloud network operating 5 data centers in the Greater Toronto area, the Greater Vancouver area, and Kelowna, and they own and manage an IP network. Now, they are the big driver, however, what has really been driving the share price and in anticipation is the potential in 5G wireless technology. Now, 5G technology is expected to be upwards of 40 times faster than traditional millimeter wave transmission technology. TeraGo is one of the largest holders of millimeter wave spectrum in Canada's largest markets. So this has been driving speculation that there could be tremendous business opportunity here for TeraGo going forward to unlock these assets. Now, the company announced on June 18th that it had closed a $6.9 million bought deal financing. They plan to use the proceeds to fund the acquisition of 6 24 gigahertz spectrum licenses, which it is currently leasing, which they were, and then they announced they had entered into a definitive agreement to acquire Mobile Exchange on September 21st for $5.7 million. And in fact, Mobile Exchange are the owners of the 24 gigahertz licenses they're planning to acquire and are currently leasing. So it had the option, it exercised this option to buy those licenses, which they had acquired that option years ago and now are moving forward on that. This has really generated a tremendous amount of interest in the stock. Now, it isn't from the underlying numbers that this company is seeing right now that is seeing growth in its stock. Revenues for the last quarter were actually down 2%, and the company had a net loss in the quarter of around 10 cents from a net loss of 8 cents in the same period of last year. Adjusted EBITDA was up 4%, but just marginally to $3.1 million from $3 million. So it is EBITDA positive, but fundamentally the core revenues in the core business, there's not a hell of a lot to get excited about. Revenue and EBITDA has remained static for a number of years, and losses have increased slightly. The underlying story again here is the company's move into the Canadian 5G market. As a relatively early mover as far as the Canadian market goes, it places Terra Firma in the forefront of the next generation of wireless communication. The market has recognized this, but the magnitude of the opportunity here is very difficult to quantify with any degree of certainty. The market sees strong potential, and the gains over the last week have shown you what kind of potential they show, and they make TeraGo our star of the week. But it is very difficult to ascertain really the value of these underlying assets, and you're certainly not seeing it in the financials right now.
No, certainly if I were to just look at the financials, there wouldn't be much that would impress me.
No. So it is something that if you want to speculate, have some exposure to 5G, there is an option there. We have a company that we recommend that is profitable, that has some exposure to 5G as well right now to our clients, and we upgraded that company earlier this year. That we believe is in a better financial position. This may be a unique opportunity where they're unlocking some of their assets there, but right now it's difficult to value from a fundamental perspective, so we'll just watch the company at this stage. That's going to put a wrap on a quick show this week. Again, I'd like to encourage you to hit us up on all our social media channels. Keep asking us questions for our Your Stock, Our Take segment, and we'll keep answering those. We keep getting more and more every week, which we're thankful for. And again, Aaron, I'd like to thank you for co-hosting with me and wish our investors out there and all our listeners profitable investing.
Thank you. Profitable investing.